Hi, good morning, everyone, and welcome to the IFRS 9 Breakfast Seminar, IFRS 9 and Credit Unions. I am Rayon Kirby, Vice President of Kuna Caribbean Insurance Society Limited, and I will be your Master of Ceremonies this morning. First up, we have the safety briefing.
Welcome to the Eric Williams Auditorium. Please take a moment off from what you are doing for this safety briefing. There are 3 emergency exits, one on either side of the stage and the main entrance. These are clearly marked in green and white exit signs. Look around you now and locate the exits that are closest to you. Bear in mind that your closest exit may be behind you. The exits and aisles must be kept clear at all times. In case of an emergency, an alarm will sound, and you will immediately proceed to your nearest exit in a calm and orderly manner. Once through the exits, please move away from the building and assemble at the muster point located at the eastern car park of the La Jolla compound. When at the muster point, please wait for further instructions from the security department. Smoking is prohibited. Smoke detectors are located throughout the auditorium. There are 2 washrooms located just forward of the main entrance, and these are also equipped with sensitive smoke alarms. It is an offense to tamper with these devices. Eating and drinking is not allowed at any time in the auditorium. For your comfort and the comfort of others, we ask that cell phones be switched off at this time. Please sit back, relax, and enjoy the program.
Right now, I'll ask you to all stand for the national anthem. Please remain standing for the credit union prayer. Thank you. You may be seated. First on the agenda, we have the welcome by Mr. Andre Gwindu, the Managing Director and Chief Executive Officer of Kuna Caribbean Insurance. Andre.
Thank you, Rayon, and I hope you've met our Vice President of Finance. Rayon is heading up Kuna Caribbean's preparation for IFRS 9 in Trinidad, the OECS, and Jamaica. One correction with regard to the safety briefing, except for breakfast. Good morning again. Commissioner of Cooperatives, Mr. Carol Adams. President of the Credit Union League, Mr. Joseph Remy. President of Eastern Credit Union, Mr. Wayne Estrada. President of TechU, Mr. Ronald Jones. Other presidents and directors, credit union CEOs, general managers, our presenters, Kyle Rudden, Price Waterhouse, specially invited guests, the media, thanks for being here. Fellow cooperators, good morning to you. Good morning to you. So I would like to welcome you this morning to this very, very important seminar, one which I hope leaves you more confident and prepared and equipped to confront the challenge of IFRS 9. I will ask one of my partners in this endeavor, Conrad NL, to frame this imminent challenge to credit unions before we bring on the main speakers. But for me, credit unions. Credit unions today, more than ever, have to stand up and lead. We have over 500,000 members who count on us in this room. They count on us for a safe place to save, a safe place to borrow. They like to receive their dividends. They count on us to interact and support our communities. This is embedded in the DNA of credit unions. They count on us for that human touch. And today, we are here to ensure we are all prepared for IFRS 9, which will impact your credit union. I would like to reinforce the collective strength of the credit union movement. There is absolutely no challenge that we face, IFRS or any other, that is insurmountable when we act together. There is more that binds us together than separates us. Kuna Caribbean has long been a strategic partner of the credit union movement here in Trinidad and Tobago, and indeed across the Caribbean. In fact, I only just returned from Jamaica, where we celebrated with the Jamaican movement 75 years, and Kuna Caribbean was recognized for being the strategic partner. In the past, we have mounted strategic interventions of this nature on our own, and in some cases with partners in the credit union movement. In this case, it's the latter. Partners in the credit union movement, how important is that? Let me share. During a meeting with our actuary, Kuna Caribbean's actuary, Mr. Kyle Rudden, he floated this idea because of the work we do. Now, Kyle is very experienced, and Kyle has actually been conducting IFRS training in other Caribbean jurisdictions. And I felt it was a great opportunity to leverage this experience for credit unions in Trinidad and Tobago. At a credit union management program here at Eastern during October, we all know Credit Union Month. In casual conversation, I mentioned to Conrad that, listen, I had this conversation with Kyle and we're thinking about doing this thing. And immediately Conrad said, I and that. Let's move forward. Next thing I know, Conrad has a conversation with Brian Tangwell at TechU. Brian and I talking on the phone, Andre, I and that. We really need to do something. And I share this to say, together we can achieve more. This morning is an example of cooperation among cooperatives, a founding principle of the cooperative movement, principle number 6. So I would like to thank Conrad, thank Brian, thank Eastern and TechU for helping making this morning a reality. And I would like to ask each credit union represented here this morning to absorb what is presented, to ask questions in the Q&A segment, and to leave here confident that our credit union movement can address this IFRS challenge. And further, resolve that together we can address any challenge that may arise in the future. So, in closing, let me thank you again for being here. I want to acknowledge the teams that worked to prepare and have this morning ready for us. And I want to ask you to have a wonderful morning with us and to leave here empowered. Thank you.
Thank you, Andre. And now we'll have the introduction by Mr. Conrad Anel, the Group Chief Executive Officer of Eastern Credit Union Cooperative Society Limited. Mr. Anel.
Good morning. You know, normally I do this because I think it is important that I understand who I am dealing with. So before I get into what I have to say, can I just see how many managers we have here, please? So the rest are leaders, directors. Senator Stephen Priest, Mr. Carl Adams, President of the Cooperative Credit Union League, President Estrada, President Jones, distinguished leaders in the credit union movement, colleague presenters. I want to, first of all, thank you for accepting our kind invitation to discuss a challenge that we believe must be understood as we continue to do the work that many of us have done for many years. Let me at the onset recognize the leaders represented by the Board of Directors of CUNA Caribbean Insurance Society Limited, TechU Credit Union, and my own board at Eastern Credit Union for bringing us together to discuss an issue that has been in discussion, strangely enough, for many years in other jurisdictions. And once they had decided to resolve their issue, they basically said to us, with effect from the 1st of January 2018, you need to comply. What is it that we need to comply with? And how do we respond? Well, as I started to discuss this issue and learn a little bit more about this issue, I recognized that we had no clue, was not prepared, and didn't even understand the conversation that was taking place. And it is strange where this occurred. The Caribbean Institute of Auditors and Accountants asked me a couple of months ago to address them in Guyana on oil and gas. And while there, Kyle and Dwayne were talking about the things that they knew about. And we started to talk a little bit about IFRS 9. And when you get to the stage where you need an actuary who understands finance to try to explain the issue to you and to say to us that, here, what, I'm really not sure how you're going to deal with that, I was concerned. Because what is taking place is that fundamentally, the way that we transacted in the financial services sector had changed. Today's event, in my opinion, therefore, is significant because we in this room are responsible for $13.8 billion, as stated by the Central Bank of Trinidad and Tobago. That's what we manage. But it was accumulated by 560,000 members, or 38% of our population, as stated by the Minister of Labor and Small Enterprise Development in 2016. It seems to me, therefore, that we are not insignificant in the impact that we make on the lives of ordinary people, and therefore we need to behave in a way that represents and protects their interests. While others may disagree, we have been at the forefront of looking after the interests and well-being of ordinary people, as it was in 1950, so it is today. It is our responsibility to manage the financial affairs of our credit unions and various institutions with care and skill, so that our members can continue to have a credible alternative to other sources of financing. Let's be clear about something. We have members who basically interact with other institutions that disguise their products and services and basically charge them, in some instances, we worked it out, as much as 60% interest, and they happily pay it. I think that there are few who are doubtful that the world has changed, and few who believe that we have a solution to the many issues that we must confront. The world as we know it has changed, and this has happened in full view, with some of us involved in this change. In fact, many of us instinctively know that something is happening because we have been around long enough to feel it. But what is it, and can we survive it? Recently, a global institution, in reviewing, as they do, the global financial landscape, made the following disclosure. And I think that it is important that we understand this statement. Powerful forces are transforming the industry. That's the financial services industry. Growth remains elusive. Costs are proving hard to contain, and returns remain stubbornly low. Regulation is impacting business models and economics. Today we will see that in action. But in addition to that, technology is rapidly morphing from an expensive challenge into a potent enabler of both customer experience and effective operation. Technology is the other elephant in the room. Non-traditional players are challenging the established order, leading with customer-centric innovation. New service providers are emerging. Customers are demanding even higher levels of service and value. And while all of this is taking place, it is taking place in an environment where trust is at an all-time low. Against this background, 70% of global bank executives from the study believe it is very important to consider how macro trends will impact the financial services sector. And in this regard, we have to take into account the current situation we have in Trinidad and Tobago, where since 2009, we have been basically living on loans. 55% of these executives view non-traditional players as a threat to traditional business, our traditional business. But here is the reality of this group. The report tells us that 20% of executives feel well prepared for the future. 80% do not. If you take this in the context of our own preparation for this reality, I think that the numbers may be similar. But what about us? In the post-emancipation period, formal financial institutions catered to the upper classes in our society, while the lower class or ordinary people that we serve remain largely underserved. It was at this time that informal financial institutions such as our credit unions emerged to serve the broader class with simple procedures, minimum collateral requirements, and low transaction costs. These institutions, our credit unions, built savings for the ordinary man and woman. As credit unions expanded, they complemented the formal banks. They competed with the formal banks. And we grew into substantial numbers nationwide and eventually catered for all persons. Today, credit unions serve many of our citizens, and based on our continuing growth, we remain relevant today more than ever. But there's a disturbing trend that we are seeing, and that is members who are currently in our system are finding that they will not be able to participate in the formal financial system as a result of new compliance requirements. This has led to a new emerging discussion on how do our institutions serve those who we are now referring to as unbanked. There is a new discussion on new methods of service delivery, and we're not going to talk about it today. We have to get into a discussion very shortly on the use of blockchain technology and, of course, cryptocurrency. We need to understand those issues. But have we seen any changes in our journey? During the 1950s to 60s, there were 192 credit unions. They were successful. Their success was encouraged, and in the budget of 1970, the then Minister of Finance stated, our long-run objectives are to make our economy subject to greater national control, economic diversification in the sense of strengthening the sectors of the economy other than petroleum and more employment. These objectives, and I think it is important that we understand where this position is, these objectives can only be achieved by the effective mobilization of local savings for productive investment at home, the building up of new and nationally controlled financial and other institutions. It is, therefore, a policy position of governments in the past that our sector do what we do and do it successfully. In 2002, the policy conversation continued because the cabinet appointed a committee looking at liberalization and modernization of the local financial sector, and in that sense, created some space for the credit union movement, because at that point in time, we were a 2.6 billion contributor. Clearly, policymakers recognize the need to support credit unions as an instrument of savings mobilization. This is going to be important after today. And as we discuss this new issue today, we may need to remind policymakers that we continue to have an important role to play in the national development agenda during difficult economic times, and therefore we must be supported in our work. My friends, we understand there are challenges. We also understand that many of our institutions are not ready. And therefore we begin today with a discussion on exactly what are we expected to do from 1st of January 2018 when new standards are introduced which affects how we can do business as financial institutions. However, I believe it is important to revisit our origins so as we move forward, it is anchored in our ideals as a people. When we examine the performance of banks and credit unions, we note the following. And you will see me make a statement amongst banks and credit unions because I think it is important for the conversation that we're going to have in a few minutes. Since 1990, the information tells us that we've had 8 banks. Well, let's look at distribution. Forget ownership structure. In 1990, we had 400 credit unions, 121 branches. In 2000, we had 356 credit unions, 123 branches. In 2010, 131 credit unions, 133 branches. In 2012, 131 credit unions, 135 branches. In 2016, we have 129 credit unions and 15 ATMs. The banks have 137 branches plus 442 ATMs. We need to understand that there are some channels that we have to deal with. In 2016, the assets of credit unions are 13.5% at $13.821 billion, while the banking sector has assets of $138 billion, or 35% of financial assets. Interestingly, the data suggests that in 1990, banks controlled 36.3% of assets as compared to 4.92% at that time by credit unions. The lessons here about consolidation and scale, I am sure, will have to be discussed at some other time. But for today, we will focus on auditing and its impact on our business model. We have been at some level very successful, and we must build on that success. Today's deliberations is intended to share with you the new requirements. While IFRS 9 requirement present challenges of itself, we also need to consider other issues that are impacting the way in which our credit unions are expected to operate. And I will basically just give you two and then move on. The first one, and we have to treat with this, is customer expectations in the future. I believe that customer service and deep customer relationships would be an absolute necessity in the future. Organizations of today have a very simplistic understanding of customers and a complex product set. However, it is my view that in the future, organizations will be forced to develop a more complex understanding of their customers and simplify their products, and so deliver a significantly enhanced customer experience. In this regard, if we do what we say we are about, we're ahead of the competition. But I think that there's something else that I need to put on the agenda that we absolutely need to consider, and it is technology, technological capabilities. And very recently I came across a new term, certainly for me, and it is called an internet minute. And this is one of those nice to know, so let's go. During the next 60 seconds, let me tell you, with technology, with the internet, what is going on in the world. Could you time me, please? 30 seconds. Sorry, 1 minute. That is what, 60 seconds? 60 seconds. During these 60 seconds that I will speak, here is what is taking place in technology. We have 900,000 logins on Facebook, 10 million text messages, 4.1 million videos viewed on YouTube, 342,000 apps downloaded, 46,200 posts uploaded on Instagram, 452,000 tweets sent, maybe one from President Trump, 158 billion emails sent, 120 new accounts opened on LinkedIn, 15,000 GIFs sent via Messenger, $751,523 spent on online shopping, 7,017 hours watched on Netflix, and 3.5 million search queries done on Google. That is happening every single minute in technology. And the question is, do we still believe that we can stay outside the technology agenda? Technology is here, and it is changing the way we do business. One other issue, demographics. I want to suggest that we have an opportunity that we can leverage when we consider demographics. Consider the significance of the time that we are living in, where the millennials, or the millennial generation, is the last generation to remember a world without the internet. Millennials are both the first generation to form their world perspectives from a digitally influenced vantage point, and the last to remember what it's like not to always be connected. It seems to me, therefore, that those who do not seek to understand millennials may inherently never understand how to engage generations beyond millennials, as well as digitally enabled talent today, regardless of generation. And of course, we need to have a strategy to engage them. The next issue is regulatory requirements, and today we intend to explore exactly what this means to us. IFRS 9, which as I understand it is effective the 1st of January, is something that we would spend time exploring. Are we ready? I think I will leave the answer to this question after our two presentations by our distinguished presenters. Practical solutions for credit unions and the auditor's perspectives are two areas that we would explore. Our commitment is based on a principle that we hold sacred: cooperation amongst cooperatives. And while some may say it is dated, let me place this therefore in modern language. Today, technology is a disruptor. Disruption is the new normal brought on in large measure by technology. The technical response to this challenge is collaboration. The way you deal with disruption is by collaboration. As we collaborate and begin to address the challenges of a new reality, we must collaborate and use all our resources. Put another way, the time is now for us to seriously develop the principle of cooperation among cooperators. Thank you so very much.
Thank you, Mr. Anil. Now, I hope we are all very excited on what's about to come. Up next on the agenda, we have an auditor's perspective on IFRS 9 being presented by Mr. Dwayne Rodriguez Sejas, the assurance partner at PwC, and Mr. Hasib Mohammed, technical partner at PwC. Now, before I invite Dwayne and Hasib up to the podium, I would like to provide a brief bio on both presenters. Dwayne Rodriguez Sejas is a partner within the assurance line of service at PricewaterhouseCoopers, Trinidad and Tobago. Dwayne is a fellow of the Association of Chartered Certified Accountants and member of the Institute of Chartered Accountants of Trinidad and Tobago. Dwayne has been with the firm for more than 17 years and has practiced primarily within the financial services sector with clients in commercial banking, investment banking, asset management, life and general insurance, brokerage and credit union sectors. In his role as engagement leader, Dwayne is also involved in advising clients on the implementation of IFRS 9 and is currently involved in several IFRS 9 implementation projects. Hasib Mohammed is a technical partner at PricewaterhouseCoopers, Trinidad and Tobago, and has over 25 years of audit experience and has led a number of audit engagements for large companies in a variety of industries, including manufacturing, energy, communication, pharmaceutical, financial services companies, and owner-managed enterprises. As the firm's subject matter expert on international financial reporting standards, Hasib has provided technical guidance to clients on implementing new accounting standards, including IFRS 9. He has conducted both in-house and client training services on financial reporting standards and has presented at numerous seminars on behalf of the firm. Hasib is also a practicing member of ICAT and a fellow of the Association of Chartered Certified Accountants. We welcome Dwayne and Hasib. Thank you.
Thank you, Rion. Good morning, everyone. I think I have a mic here. All protocols observed. I think Andrea and Conrad listed a number of dignitaries here, and I'd like to say good morning to you all. And thank you to CUNA and Eastern Credit Union for putting on this seminar and inviting us to speak. I want to take a minute to applaud CUNA and Eastern Credit Union for taking the initiative to host this seminar today. And also to applaud those of you who made the time to attend. I understand there was overwhelming demand for spots, and not everyone that asked was able to be accommodated. So give yourselves an Eastern and CUNA a round of applause, please. And thank you, sorry. Is this working? Okay. We really at PwC believe that a collective approach to IFRS 9 is the best route to successful implementation. An example I would give is that we are currently doing a collective project with the Credit Union League in Jamaica, which involves at least 28 credit unions. And we think the challenges and the solutions are better approached collectively. So I really want to applaud you all for taking the initiative to come here today collectively to approach this. So what are we going to talk about today? We're going to talk a little bit about the genesis of IFRS 9. Where did it come from and when? We're also going to talk about the key aspects of the standard. So what is changing? We're going to talk about how this could impact credit unions. We're going to get into a little bit more detail about 3 specific elements of the standard: measurement and classification of financial assets and impairment of financial assets. And then we're going to talk a little bit about the challenges and possible solutions. And I know Kyle is going to speak quite a bit also on these challenges and possible solutions.
Thanks, Wayne. So I'm just going to talk a little bit about the genesis of IFRS 9. So it's the first time I ever saw so many people looking at me about IFRS. That's not a normal thing, right? Everybody's normally kind of think it's not going to be good. But IFRS 9 was developed largely in response to really 2 concerns that took place. And we would all remember this, but in 2008, there was a great financial crisis across the world, primarily in the US. And because of that, that really kick-started a rethink of the standard IAS 39, which is what we now comply with. Why? Well, there was a meltdown worldwide because of the fact that investments were impaired, and at the date of impairment, this was now recognized in the profit or loss account. And lots of companies went insolvent, had to go to governments to get loans to bail them out. So what happened was that the big countries, you know, the G8, G20, got together and said, we can't let this up with something that actually would recognize potential losses and losses earlier. Go back to that drawing board. And recognize potential losses or impairments to investments and to loans earlier than you recognize it under IAS 39. So, because of that, they went back to the drawing board. And they came up with a different approach to looking and recognizing losses that may occur when you invest in bonds, when you invest in giving loans to clients, and recognizing those losses earlier. So that was really why, because of 2008 and the financial crisis, they wanted, instead of recognizing a loss when it occurred, to recognize it earlier. And more about that as we go down in the presentation. Dwayne will deal with the technical part of that. So that is first of all. IS 39 is pretty complicated, right? When you read that, you know, it's just really rule-based. Sometimes, lots of times, it doesn't make really sense. It doesn't actually reflect economic reality. So one of the watchwords of Hans Roosevelt, who's the new IASB chairman for the last 2 years, is that he wants to have standards that represent how business works. So he wants it to be more substantive, reflect economic reality. And as a consequence, IS 39, as we'll talk about in a little while, tries to reflect the economic reality of investments and the economic reality of how a business goes about its day-to-day activities. So we find it moving away from a rule-based sort of standard to a more principle-based standard. Reflect what actually happens. And you will see we'll talk about that a bit more. Right? So we talked about two things, IS 39 being too complex, going towards what? Economic reality. And what was the second thing? Losses recorded by financial institutions too late and too little and too late. So we're going to say that IFRS 9 addresses those two concerns. Right? And finally, notice I said 2, but we ended up with how many? Don't you ended up with there? 3. That's IFRS 9, right? We start talking about it and say this is the impact, and then you realize it's a big impact. So where there's 2, there's actually 4. Impairment of equities. So what happened? There were some Australian companies who invested only in equities. And when there was that financial crisis, these shares fell in value. When the shares fell in value under IS 39, the impact of that gets reflected in the profit or loss account, right? So these were shares where increases in value went first to what we call, not the profit or loss account, but a reserve in the balance sheet. We call it, the technical terms of other comprehensive income, but a reserve, not to the profit or loss. And if there's a loss, then if some conditions are satisfied, it gets eventually written off to the profit or loss account, right? So it impacts in terms of the ability to pay dividends. What happened is when these shares recovered in value 2 years later, and there was an increase in the value of shares, the increase in the value of shares did not get reflected in the profit or loss account. It went to this balance sheet reserve account. So you continue to have big retained losses even though there was appreciation in the value of the shares. So then you couldn't pay dividends because you still had a big retained loss. So they said this can't work. So IFRS 9 came along and tried to solve that problem with respect to equities. And we'll talk about that in a couple of minutes. So those really was the genesis as to why IFRS 9 came to the table. And as we discuss over the next hour or next 45 minutes, what did IFRS 9 do to treat with those issues? Turn you over to Dwayne.
Thanks, Asim. Right, so that was the why. What happened? So there were 3 main phases of IFRS 9. The first of those phases dealt with classification and measurement to address the first issue, Asim raised, and the third issue. So what they tried to do is to make the guidance less rule-based and more principle-based, as Hasib said, and overall to simplify the guidance on how to classify financial assets. That became available in 2012, and at that point, IFRS 9 was actually supposed to have an implementation date of 1st January 2015. So between 2012 and 2014, there was actually a lot of discussion around preparation to implement IFRS 9. What then happened was they started working on the impairment part of the standard. And there was a lot of back and forth between the ISB and practitioners in the market and auditors as to what would make sense. And they landed on what is now the expected credit loss model, which we'll talk about a little bit later on. And then push the effective date out to 2018. Because it took so long to come up with this model, they recognized that it would take even longer for people to be able to implement it. The last piece was hedge accounting, which we're not going to spend a lot of time on today. The rules under IAS 39 for hedge accounting were very complex. What they've done is simplify it to a large extent, but it's not something that is practiced significantly within our region, and it's not something we find a lot of entities focusing on. So what's the impact of IFRS 9 on credit unions? This graphic is not meant to be a downward arrow. So let me start by saying the overall impact of IFRS 9 is that over the life of an asset, the losses or gains you record do not change. The overall losses or gains recognized over the life of an asset under the old standard and under IFRS 9 are the same. What is different? It is more prudent. So you recognize those losses and gains in different places and earlier. All right? And I say losses and gains because the classification and measurement part of the standard means that things which may have gone through reserves before will now start going through the P&L. All right? So it gives businesses a little bit more of a window to put things in profit and loss that you believe should be in profit and loss. All right? But it does make the loan loss approach a lot more prudent. Naturally, those things have an impact on the profits of your credit unions, and that has an impact on the dividends you can pay to your members. And I'm sure they're all concerned about the dividends as well as your sustainability. So anything that affects your P&L will ultimately affect your retained earnings and your reserves, will ultimately affect the equity that your members have in the credit unions, and will ultimately affect the ability of the credit union to withstand shocks and to continue business going forward into the future. IFRS 9 is meant to bring those risks that the business faces to the forefront earlier. Not to make it worse for the business, but to give the business more time to deal with them in a real way before the business collapses, which is what took place in the global financial crisis. All right, so the objective of the standard is not only to change the way the accounting works, but also to change the way that people do business. Okay?
Yeah, thanks. So really important is really to think about IFRS 9 as managing financial risk and giving you the tools to do that and to reflect that in the financial statements. Financial risk being what? Credit risk. Financial risk being what? Exchange rate risk. Financial risk being interest rate risk. That's what we think about when you think about risk with respect to a financial institution. So first of all, I'm just going to deal with the asset side of the balance sheet. And thereafter, Dwayne will deal with the provisions part of the balance sheet in terms of how do we recognize a provision, right? So first of all, there has been a change in how we measure, how we classify financial assets, right? So they have normally on a balance sheet two: shares, equity instruments, and debt, right? So those are really the two that you find on most balance sheets. So let's just talk about equities and what was done, what has been done in IFRS 9 with respect to equities. So because of, in my discussion with respect to the genesis of IFRS 9, there was this issue of where you had investments being valued to a fair value reserve, which wasn't reflected initially in the profit or loss account. And then that impairment that went through the profit and loss account, they said, let's change that. Let's take this view, right? Once you don't hold a share for trading, i.e., there's not an intention to make a profit in the short term. So in Trinidad, we normally buy shares and hold it for a strategic reason for a longer term. That's been the culture when you look at pension plans, when you look at most financial institutions, right? So we actually don't trade in it. In other words, look to turn a profit in the short term, right? Then for those, once you don't do that, then you have an option to take all those gains or losses on those shares subsequent to buying it. So I bought a share for $50, put it on the balance sheet, credit cash, debit investment, $50. And there was, let's say, an appreciation in the value of the share from $50 to $60. You can either, if you're not holding the share for trading, the $10 will not go through the profit or loss account. Where it will now go through a reserve account in the balance sheet. The technical term is other comprehensive income, right? So it will go there on the balance sheet and in the balance sheet. And when it goes there, if there is a gain, first of all, if there's an impairment, the impairment will never be reflected in the profit or loss account. It will stay in the balance sheet, right? So that's the way they've got around now impacting on the retained earnings of the company that happened back in 2008 to all those Australian companies who were basically dealing with shares, right? Secondly, when you actually sell the share, so let's say some point in time you sell the share, what happens to the profit or loss you make on selling the share? It stays there, it doesn't go through the profit or loss account. It stays in other comprehensive income. So it leaves whole your retained earnings. So that was the key change in terms of treating with shares with respect to IFRS 9 compared to what we have now. In IAS 39, if you had those shares fair value through this reserve, if there was an impairment that was basically held to be permanent, right, or to be significant, then that loss would now, prior to 2018, go through your profit or loss account. And then if there was appreciation in the value of those shares, it wouldn't go back to the profit or loss account. So you'll have this loss sitting in your P&L. Come 1st January 2018, that is not going to be the case under IFRS 9. That loss is going to stay where? In the fair value reserve, in this place we call other comprehensive income, and it will not go through the profit or loss account, right? So that is the first, that was because of what happened in IAS 39, they have come up with this. So that's what we say here. Are you holding it for trading? If the answer is no, do you intend, basically, well, in terms of this, are you going to, has the company taken the election to basically keep it at, oops, not sure what happened there. Right. So has the company taken the election in terms of that? Yeah. Has the company taken the election to keep it in OCI? And if it's yes, you leave it there and it will never go through the P&L. No recycling. So when you use the word no recycling, when it's sold, profit or loss stays in OCI. So that was the fix in terms of that. And they took the view that that was consistent a lot of times with management holding shares for strategic value for the long term, right? And if you're holding it strategically for the long term, you really don't want your profit or loss account going up and down due to the change in the value of that share. Because a change in the value of the share is a non-cash transaction, right? Doesn't mean you have more cash to pay out dividends. It says that you have more value on the balance sheet, but it is what? Unrealized. So conceptually, that made sense. So increasing our value in that share says you're only going to have the cash to pay out if you do what with the share? If you sell it. But if you hold it for a long term, then you really don't have the cash that goes with that to pay out a dividend. So therefore, putting it through the profit or loss account may not necessarily reflect your ability to pay dividends. It will reflect that you're profitable, but you don't have the cash, right, in terms of that. So strategically, that made some sense in terms of why they got to that particular answer. So for once, the IASB seems to be logical and consistent with budget. The second change that took place was with respect to where we have investments like in government securities. When you say debt instruments, you have investments in government securities or you have investment in corporate bonds. So let's say government securities, right? So what did they say with respect to this? They said, well, hang on, we could end up in 3 places here under IFRS 9. So they asked the question, first of all, this bond that you have from the government, right? What is your intention with this? So we have moved away from where? Rule-based to where? What the business want to do, right? What is the business strategy in treating with these particular investments? So they said, okay, do I want to hold this for the long term? If the answer to that is yes, then the next question they ask is, are the payments that I receive in this bond solely payments of principal and interest? Nothing else. Only principal and interest, right? Is it only that? We call it a vanilla bond, plain. Well, I love vanilla. I don't know what plain about it. But solely payments of principal and interest. And if they are solely payments of principal and interest, then we reflect the bond on the balance sheet and at cost, and all payments of principal and interest get reflected against the bond for principal and against the P&L for interest. So that is what we know under IAS 39 as, the word for that is called amortized cost, so those who know about that too. Right? So it's really the bond being repaid by the government, right? Getting your principal and then getting your interest reflected. So that is where we have what we intend to hold for the long term, right? Then they say, well, you know, sometimes businesses may have investments in bonds, they intend to hold it, right? But if they get a good price for it, they're going to sell it. If they get a good price for it, they will do what? Sell it. Or because you're managing your financial risks and matching your assets with your liabilities, to rebalance the portfolio, you might choose to sell a bond. In other words, to get cash flow to make good payments, right? So there's two reasons that you might choose to purchase a bond, but hold it to collect, but also want to have the option to sell it. Because you might want to do what? Rebalance your portfolio to match your assets with your liabilities. Or you may find, hey, there's a good price going for it now, I can make a good profit, let me get out it and sell it and buy something else, right? So if there's an intention where you get to hold, to collect it, and to sell it, in that case, for that government bond, we fair value that through other comprehensive income. We do what? Fair value through other comprehensive income. So I can have the same bond, two of the same bonds, right? Two parts of the same bond, and I can have one at hold to collect, and one at hold to collect and what? Sell. So the same bond, two different tranches, and I have one at amortized cost, and I have one at what? Fair value through where? OCI. So what is that predicated on? Is it a rule or is it a business? How the business approaching its investment portfolio, right? So IFRS 9 has moved away from IAS 39 with a rule-based approach to what kind of approach? Mirroring what the business is doing, what the investment managers are doing, what that investment committee, what they are thinking of how to manage their investments. And finally, you could have a debt instrument where there's an intention to trade in it. I ain't holding it to collect. I ain't holding it to collect and sell. I looking to make short-term profits. What do you think we do with those? Fair value through where? Profit or loss account. We are holding to do what? Trade. So we have moved away from IAS 39 from an investment perspective where it was driven based on rules to where it is now driven based on your intention and your investment strategy. So to summarize, equities, if you're not holding it for trading, you make a one-time election and it goes through where? Other comprehensive income. If you're holding it for trading, you're fair valuing it through where? Profit or loss account. Debt, three scenarios. Hold to collect, amortized cost. Hold to collect and sell. Why you might want to do that? What's the reasons? To fair value it, to rebalance the portfolio, to take a profit if you get a good price. Fair value through where? OCI. And if you're holding it to trade, then where are you going through? Fair value through P&L. So I've given you 5 scenarios for 2 investments, right? For debt,